It's Monday night, December 22nd, 2025. And if you came in here looking for comfort, reassurance, or bedtime stories, you're in the wrong damn building. I'm Avatar John. I've got the wheel tonight. And I'm not here to hold your hand. I'm here to tell you what's real. This market is not broken. It's not bearish. And it's definitely not stupid. It's patient. While everyone else is yelling, why isn't it moving? The smart money is loading pressure like a spring. And the reason you feel uncomfortable right now? Good. Discomfort is the admission price before power. Before we go any further, smash the like, hit follow, and share this with the guy who's been wrong all year, but still tweets with confidence. Now lock in, because tonight we're talking about why volatility is pinned, why supply is vanishing, why leverage is cracking, and why the next move will not ask for permission. This is the garage. The engines are running, and we're about to separate people who watch markets from people who understand them. Let's get to work. Here's where we are, and I'm going to say it once so it actually lands. We are in a risk-on reflationary regime, but we are not in the fun part yet. Anyone telling you otherwise is selling dopamine. This is the transitional phase, the phase where liquidity tightens mechanically while reflation forces build underneath. That combination messes with people psychologically because the macro story says up, but the tape says wait. Think of it like an engine revving at redline with the clutch still pressed in. You hear the power, you feel the vibration, you know what's coming, but nothing launches yet. And that's why amateurs are confused. They're staring at the screen asking, why isn't it moving? Because markets don't reward impatience. They punish it. Bitcoin isn't exploding. Alts aren't mooning. Volatility feels dead. That doesn't mean nothing is happening. It means pressure is being stored. This is the quiet part before leverage either gets rewarded or annihilated. Right now, Bitcoin is compressed into December 26th options expiry. Over $23 billion in notional sitting there like a steel clamp. That clamp is not accidental. Market makers are pinning price. Gamma is suppressing movement. Every breakout attempt gets absorbed. Calm on the surface, violence underneath. This is how real moves are built. Not with excitement, but with boredom that breaks weak hands, forces bad positioning out, and leaves only people who can sit still. That's where we are. What the market is lying about. Now let's talk about the lie everyone keeps repeating. ETF demand. People throw that phrase around like it's the answer to everything. Like it's some magic lever that guarantees price goes up. It's lazy thinking. And it's wrong. ETF demand is not the story. It's a wrapper, not a driver. Here's the truth nobody on social media wants to say out loud because it ruins the fantasy. Bitcoin exchange supply is down to 2.76 million coins. That's roughly 13% of total supply. Let that actually register. Over 400,000 Bitcoin have left exchanges this year alone. That is not demand chasing price. That is supply quietly vanishing. No fireworks, no viral tweets, no retail celebration. Coins are leaving the casino floor and going into vaults. That's how real positioning happens. And here's the part people don't understand. When supply disappears like this, it doesn't immediately pump price. It thins the market. It makes every future move sharper, faster, and more violent. Now layer in derivatives, because this is where the real lie gets exposed. CME open interest has collapsed to the lowest level since early 2024. That tells you institutions are not piling into leverage. They're stepping back. At the same time, funding spiked aggressively. USDT funding blew past 10%. That is not bullish enthusiasm. That is capital shortage. That's traders competing for collateral. That's leverage paying a premium just to stay alive. That's money getting expensive in real time. When capital gets expensive, nobody hits the gas. They tighten risk. They reduce size. They wait. And when capital gets scarce, markets don't explode upward. They compress. They choke. They sit there doing nothing long enough to make everyone impatient, emotional, and sloppy. That's not accidental. That's design. This is how markets shake out people who need constant stimulation. That's why price feels dead. While the data feels alive, That's why nothing happens, even though everything important is happening underneath. And that's the mistake most people make. They think price leads structure. It doesn't. Structure leads price, and price follows when the trap is ready. So, no, this isn't a contradiction. It's not bullish versus bearish. It's a setup phase, a phase where the market lies to you with boredom before it tells the truth with violence. Now, let's talk about what's actually breaking quietly while everyone stares at candles. Because the most dangerous damage in markets never announces itself, it whispers. Under the surface, parts of the system are already cracking. DeFi yields are rolling over. Synthetic structures are leaking. Protocols that only worked when liquidity was abundant are suddenly being stress tested. That's not coincidence. That's what happens when capital stops being free. Ethena is a perfect example. Total value locked didn't drift lower. It collapsed. That's not retail panic. That's confidence exiting. When yield narratives break, they don't just hurt one protocol, they expose the entire assumption that there will always be liquidity. And once that assumption dies, leverage has nowhere to hide. Now look at stablecoins. People love to say dry powder is waiting, but here's the reality. Stablecoin supply is not expanding aggressively. Large burns are happening. Fresh minting is muted. That tells you something critical. Capital is protective, not aggressive. Money is parked. Money is waiting. Money is not chasing. That's why rallies stall. That's why breakouts fail. That's why every move higher feels heavy. And here's the uncomfortable truth. Markets don't reward optimism in this phase. They reward patience and balance sheets. This is the chapter where weak structures get exposed, overbuilt narratives get questioned, and only things tied to real demand survive. You don't see this damage on a 5-minute chart. You see it later, when the next leg starts and half the market never comes back. Why this phase feels so miserable? Let me explain why so many people hate this part. There's no dopamine, no clean trends, no heroic breakouts, no easy money. Just chop, compression, false starts, and that's intentional. This is where markets force you to choose. Do you want excitement, or do you want to be positioned when it matters? Because you don't get both. This phase exists to exhaust people emotionally, so they're gone when the real move begins. That's not theory. That's how every cycle works. The macro trapdoors. Pay attention here. Now zoom out, because this is where the switch flips. Liquidity right now is fragile. The Fed cut rates, but liquidity didn't get easier. Why? Because the Treasury is rebuilding its account, draining reserves out of the system. At the same time, the reverse repo facility is basically empty. That safety buffer is gone, which means the system is flow sensitive. Small shocks create big reactions. Now add Japan. The yen is flirting with intervention territory again. 160 is the line. If that carry trade unwinds, correlations snap to 1 and everything sells together. No nuance, no safe havens, just liquidation. That's the trapdoor. It hasn't opened yet, but it's creaking. Why this sets up the next move? Here's the part you need to internalize. Compression plus supply reduction plus leverage reset does not end quietly. It ends with release. The market is storing energy right now, and energy doesn't disappear. It moves. The only question is who's still standing when it does. What the tape is quietly screaming. Now let's talk about what the tape is actually saying. Not the headlines people are reposting for dopamine, but the behavior underneath. Because while price looks calm, pain is happening in size, real size. Look at what's actually crossing the wire. You've got whales locking in catastrophic losses. One wallet just dumped over 16 million ENA into Coinbase Prime. Tokens bought near the highs, now sold at an 81% loss. That's not profit taking, that's capitulation. Another wallet unloaded billions of pump through Falcon X, down more than 60%. Again, not rotation. That's forced reality. This is what leverage unwinding looks like when it finally hits large players. Not panic tweets, silent exits through prime desks. At the same time, You're seeing something else that matters even more. While some whales are getting smoked, others are doing the exact opposite. Tom Lee's Bitmine quietly bought nearly 30,000 ETH, close to $90 million through BitGo and Kraken. No announcement, no hype, just accumulation. Another large Ethereum wallet sold enough ETH to fully repay loans, then immediately withdrew the remaining 24,000 ETH from Aave. That's not bearish. That's deleveraging, then custody. That's someone cleaning up risk and deciding they still want exposure. Same with Aave. The founder himself stepped in and bought tens of thousands of Aave, fully aware he's sitting on unrealized losses. That's not a trade. That's conviction buying into weakness. So what does that tell you? It tells you this isn't a one-way market. It's a transfer market. Weak hands are being forced out at scale. Strong hands are stepping in quietly, off exchange, after leverage is removed. That's the pattern. Now layer in the macro confirmation. Gold just printed a new all-time high at 4,450. That is not crypto money rotating. That is institutional hedging. At the same time, Washington just swore in a pro-crypto CFTC chair, and Congress is openly talking about sending crypto market structure legislation to the president's desk. That's not noise. That's the regulatory floor being poured while the market is still distracted by price. Add the Pentagon partnering with XAI to expand its AI arsenal. Add Bank of America's CEO saying AI will drive strong growth in 2026. Add Japan issuing its sternest yen intervention warning in years. What does all of that tell you? It tells you we are not in a collapse. We are in a late cycle compression phase where risk is being repriced, leverage is being purged, and capital is choosing sides. Some are blowing out. Some are locking up supply. Some are hedging in gold. Some are positioning for what comes next. And the market is lying to you with boredom so you don't see it happening. That's why price feels dead while the tape is anything but. That's not random. That's deliberate. The trapdoors. This is where calm turns into violence. Now pay attention because this is where quiet markets turn dangerous. Right now, everything looks calm because the safety mechanisms are still engaged. But those mechanisms are thin. Very thin. First trapdoor, liquidity plumbing. The Fed cut rates earlier this month, but liquidity did not get easier. Why? Because the Treasury is rebuilding its account. Hundreds of billions of dollars are being pulled back into the Treasury General account. That drains reserves from the system, whether people like it or not. At the same time, the reverse repo facility is basically empty. That used to be the buffer. That buffer is gone, which means the system is now flow sensitive. Small shocks don't get absorbed anymore. They propagate. That's how calm snaps. Second trapdoor, Japan. The yen is flirting with 160 again. That is not a random number. That is the intervention line. Japan has already issued its sternest warnings in years, saying the yen is deviating from fundamentals. If that carry trade unwinds, even a little, correlations snap to one. Crypto sells, tech sells, risk sells. Not because fundamentals changed, but because global leverage gets forced to rebalance all at once. That's how accidents happen. Third trapdoor, options expiry. Bitcoin is sitting in a volatility clamp into December 26th. Over $23 billion in notional options are pinning price between 85 and 100,000. That pin does not last forever. When it comes off, price doesn't drift, it releases. And it releases in the direction that hurts the most people who are positioned wrong. That's how Gamma works. Fourth trapdoor, DeFi confidence. Yield narratives are breaking quietly. Athena didn't wobble. It collapsed. Stablecoin minting is muted. Burns are happening instead. That's capital pulling back from synthetic yield and demanding real collateral. When confidence breaks in yield structures, it spreads faster than people expect. This is how contagion actually starts. Not with headlines, but with trust evaporating. Why this matters right now? Here's the key point. None of these trapdoors have opened yet. That's why price looks boring. That's why volatility feels fake. That's why people are getting impatient. But when multiple trapdoors exist at the same time, the market doesn't need all of them to open. It only needs one. And when one opens, the stored pressure does the rest. That's why this phase is dangerous for people who are overlevered, overconfident, or emotionally attached to short-term direction. And it's why this phase is powerful for people who can stay solvent, stay patient, and understand structure. Now let's talk about XRP, because this is where people either think clearly or emotionally implode. First, let's say this out loud so there's no confusion. We like the asset. We do see a future here, but liking the asset does not mean pretending it's immune to structure. Right now, XRP is trading around $1.79. That matters. It means the market has pushed it below the level where comfort lives, right into the zone where weak conviction gets tested. And here's the contradiction that's driving people insane. On the surface, price looks weak. Underneath, ownership is getting stronger. Exchange supply has collapsed. Roughly a third of XRP has been pulled off exchanges in just the last month. Large wallets have been accumulating hundreds of millions of tokens. Not trading, not flipping, accumulating. That's not noise. That's positioning. This is where the supply shock conversation comes from. And unlike most narratives, this one has teeth. But here's the rule most people refuse to learn. A supply shock is a setup, not a shield. It does not protect price during a leverage flush. It does not stop drawdowns when macro turns risk off. And it does not show up the moment accumulation starts. What it does is quietly remove float while price action stays ugly long enough to break patience. That's exactly what XRP is doing right now. Add in structure. XRP trades like beta when markets are stressed. It does not decouple when Bitcoin is weak. It does not act like a safe haven. So when leverage unwinds, XRP gets dragged, even if fundamentals are improving. That's not a flaw. That's reality. Now let's address the elephant in the room. ISO, payments, settlement narratives, all real, all long-term. None of them matter during a compression phase. Infrastructure stories don't pump on fear. They resolve after volatility clears. If XRP's role as regulated plumbing plays out the way we think it can, it will not look like a meme coin explosion. It will look boring, slow, gradual, and then suddenly obvious in hindsight. So here's the honest take. Short term, XRP can still bleed if macro pressure continues. That doesn't invalidate the thesis. Medium term, if leverage clears and liquidity stabilizes, the shrinking exchange supply and large wallet accumulation start to matter. Long term, XRP is one of the few assets in this space that plausibly fits into a regulated institutional settlement future. That doesn't mean guaranteed upside. It means a seat at the table. And in markets like this, having a seat beats having hype. So no, XRP isn't broken. It's being accumulated quietly while price action does its job and exhausts everyone who needs immediate gratification. That's uncomfortable. And historically, that's where real positioning gets built. And this is the part most people never want to sit with, because XRP forces you to confront something uncomfortable about markets. Price action is not a moral judgment. It is a timing mechanism. Right now, XRP is not being priced for its future role. It's being priced for current stress. Stress in liquidity, stress in leverage, stress in patience. And that's why this phase exists. Markets don't let you hold infrastructure assets comfortably right before they matter. They make you earn the position. They push price below comfort. They let narratives go quiet. They make you question whether the work was ever worth it. That's how weak conviction exits and strong conviction concentrates. So when people say, why isn't XRP reacting to all this good news? The answer is simple. Because this is not the reaction phase. This is the absorption phase. Supply is being pulled off exchanges. Ownership is consolidating. Leverage is being burned away. And none of that is designed to feel good in real time. If you need immediate gratification, XRP will punish you here. If you need constant confirmation, XRP will exhaust you here. But if you understand structure, if you understand timing, if you understand that plumbing gets built before traffic arrives, then this phase makes sense. XRP doesn't need hype right now. It needs time. And markets are giving it time in the most uncomfortable way possible. That's not an accident. That's how positioning is forged.
Before we roll into the garage outlook, quick pit stop. Lulu took the night off. Charts are closed. Discipline stays on. But Triple X didn't sit idle. He had a hot date tonight, so no trades. But he did some fun whale wallet hunting on Solana before he walked out the door. And what he handed back wasn't a buy list. It was intel. Here's what stood out. Out of everything he scanned, only 2 coins showed any real convergence, meaning more than one profitable whale touching the same thing within the same short window. That matters, because convergence is rare in chop like this. The main name that popped was Fantcoin V2. Multiple profitable wallets were quietly accumulating it within the same 25-minute window. No chasing, no social hype, just steady, quiet buys. That's the strongest signal from the scan. Medium confidence, nothing more, nothing less. A second name showed weaker overlap. Pump V2. Only 2 wallets involved. Very short time window. That's a low confidence observation, not a setup. Everything else? Single wallet activity only. Fast flips, rotations, no coordination. And that's important, because when real money is positioning together, it doesn't spray into 10 names. It concentrates. Now let me be very clear, because this is where people get reckless. Triple X did not trade any of these. No entries, no front running, no I'm early nonsense. He clocked them, wrote them down, and left. That's how professionals operate. This wasn't a signal, it was a temperature check. And the temperature says this: profitable money is still active. Whales are selective, not aggressive. Coordination is quiet, not loud. Tomorrow, with Lulu back and a full scan, we'll see whether Fantcoin V2 develops into something real or disappears like most things do in compression phases. Tonight was observation. Execution comes later, if it earns it. Now let's zoom back out and close this the right way.
All right, let's wrap this the right way. Tonight wasn't about hype. It wasn't about chasing green candles. And it definitely wasn't about pretending this market owes anyone easy money. This chapter is about compression. Liquidity is tight. Leverage is being punished. Supply is quietly coming off the table. And price is being held in place long enough to exhaust impatience. Bitcoin is coiled. XRP is being absorbed, not celebrated. Solana activity is selective, not reckless. Whales are watching more than they're acting. That tells you everything you need to know. This is not a go all in moment. This is a pay attention moment. The market is deciding who gets to stay for the next move. Pressure is building into December 26th. Macro trapdoors are real. And when this thing finally moves, it won't give warnings. It will move fast. It will move hard. And it will punish anyone positioned on emotion instead of structure. So here's how we're playing it in the garage. We stay patient. We stay disciplined. We don't chase noise. We let setups earn our capital. Triple X observe tonight. Lulu will be back tomorrow. And when execution time comes, it will be obvious, not forced. That's how you survive this phase. And that's how you're still standing when the real move hits. Same garage, same standards. Engines hot,